Welcome to our comprehensive guide on sources of financing. Whether you're a small business owner, an entrepreneur, or someone interested in understanding how businesses secure funding, this video will provide you with valuable insights. Let's dive in. Before we explore different sources of financing, let's understand the fundamental concept. Financing refers to the process of obtaining funds or capital to support various business activities such as starting a new venture, expanding operations, purchasing equipment, or managing working capital. The main sources of financing can be broadly classified into internal and external financing. Internal financing comes from within the organization. It includes retained earnings, depreciation funds, and sometimes controlling overheads. External financing, on the other hand, is sourced from outside the organization. Common examples are loans, equity financing, grants, and commercial paper. Let's start with internal sources. Retained earnings are profits that a company has earned to date, less any dividends or other distributions paid to investors. These funds can be reinvested into the business for growth and development. For instance, a technology startup that earned $500,000 in net profits last year may choose to reinvest $300,000 into developing new software products. This is an example of using retained earnings for internal financing. Depreciation funds are another internal source. These are non-cash expenses on assets that can be used over time to fund new business opportunities or to replace old equipment. Now, let's move on to external sources of financing. One of the most common is debt financing, which involves borrowing money to be repaid with interest. This can include bank loans, bonds, and credit lines. For instance, imagine a retail business taking a $200,000 bank loan to open a new outlet. The loan has a 7% annual interest rate to be repaid over 5 years. This is a straightforward example of debt financing. Equity financing involves selling a stake in the company in exchange for capital. This can be through selling shares to private investors or going public with an IPO, initial public offering. Consider a biotech company that raises $5 million by issuing new shares to investors. These funds can then be used to accelerate research and development of new drugs. Now, let's discuss grants and subsidies. These are often provided by government bodies or nonprofit organizations and do not need to be repaid. They are typically used to support specific projects or innovations. For example, a green energy startup might receive a $100,000 government grant to develop sustainable energy solutions. This grant supports the company's project without adding financial burden. Another form of financing is through venture capital. Venture capitalists provide capital to startups with high growth potential in exchange for equity. This is common in the tech industry. For instance, a fintech startup might receive $2 million from a venture capital firm, which in return acquires a 20% stake in the company. The funds are used for scaling operations and market expansion. Commercial paper is a short-term debt instrument issued by corporations to finance their inventory and meet short-term liabilities. It's an unsecured form of borrowing. Imagine a large corporation issuing $1 million in commercial paper to manage its short-term financial obligations, with a maturity period of 270 days and a discount rate of 5%. Let's visualize how different sources of financing contribute to the overall capital structure of businesses. This graph illustrates the typical sources of financing for a medium-sized enterprise. Common questions include: how do you decide which type of financing to pursue? It's essential to evaluate the cost of capital, the risk involved, and the impact on ownership and control of the business. What factors should be considered when choosing between debt and equity financing? Consider the cost of capital, the impact on cash flow, control dilution, and the long-term financial health of your business. Debt requires regular interest payments but doesn't dilute ownership. Equity doesn't require regular payments but dilutes ownership and may come with high expectations for growth. What are the risks associated with venture capital? While venture capital can provide substantial funding, it often comes with high expectations for rapid growth and exit strategies such as an IPO or acquisition. The control of the company might also shift to the venture capitalists. which could affect operational decisions. How can small businesses access grants? Small businesses can explore government databases, industry associations, and nonprofit organizations that offer grants. Networking and applying for various grant opportunities can increase the chances of securing funds. In summary, businesses have multiple avenues to secure financing. Each source has its advantages and challenges. It's crucial to assess your business needs, financial situation, and long-term goals when deciding which financing option to pursue. We've covered a detailed overview of sources of financing, from internal options like retained earnings to external ones like venture capital and commercial paper. We hope this guide helps you make informed decisions for your business. Thank you for watching. Don't forget to like, share, and subscribe for more financial insights. If you have any questions, feel free to leave a comment below. See you in the next video.